Good morning and welcome to this PD tax webinar. It's the 10th of December and today we're talking about tax and divorce. So today I've got my colleague Ben Aris, who's going to be morning Ben. Ben, who's very kindly and bravely stepped up to the plate today to talk about the technical aspects, some of the technical aspects of tax and divorce. Thank you, Ben. And my name's Paul Davison. A little bit about PD Tax, our vision to enrich lives by making tax simple. And a couple of things that we're about there really is, we love getting to the nub of our clients' tax situations, and we love delivering great results for our clients. That's what we're about, really. The sort of areas we're working, well, tax advice, general sort of tax advice to save money and provide peace of mind to the people we're working for. We provide tax partner service for local accountancy firms, and we also help solicitors. I'm sure there's a few of you on today's webinar. We do share valuations of private limited companies, trading companies, and investment companies. We do tax investigations and voluntary disclosures, and we do some tax return forms, just sort of more complicated ones, really, not the bog standard ones. So, housekeeping. Well, we started at 9:30 on the dot. We will aim to finish at 10 o'clock on the dot. Your mics will be disabled throughout, so you can talk all you like and we can't hear you. But you can interact, if you so wish, by submitting a question via the Q&A box. And our colleague Laura, who's hiding behind the camera at the moment, will ask those questions to us at the end. But don't worry, if your question's not answered, there's a follow-up session at the end, like a breakout session, or we can follow that question up with you offline, so to speak. And as ever, this presentation is for general information only and is not intended to constitute individual advice. It is recommended that you seek competent professional advice before taking any action. And now I think on to Ben. Ben, over to you. I'll mute my camera. Ben, it's over to you.
Oh, thank you. Sorry, my internet connection just dropped out for just a split second there. Good morning, everyone. I want to start today by talking about capital gains tax in the year of separation. Now, each spouse is going to be treated separately for capital gains purposes, and a chargeable gain will arise if there's a gift or a transfer through a divorce settlement. Now, the timing of the disposal is going to be critical. Now, transfers of assets between spouses or civil partners who are living together in any part of the tax year will take place on what's known as a no gain, no loss basis. Now, this is exactly what it says in the tin, really. Neither a gain nor a loss will arise to the donor for disposal, and effectively they will be stepping into the shoes of the other individual. Now, it's going to be irrelevant whether they're living together at the date of the transfer, but they must have been living together at some point during the tax year. And this no gain loss period will apply until the end of the tax year in which the spouses or civil partners separate. Now, there are a few exceptions to this rule. Now, first one, until disposal, the asset formed part of the trading stock carried on by the transferor, or the asset is acquired as trading stock for the purpose of trade carried out by the transferee. Another exception is a disposal by way of what's known as donato mortis causa. I'm not going to pretend like I speak Latin because I don't, but this is essentially a gift of property in anticipation of death, and different rules will apply here. And as you can see at the bottom of the slide, it doesn't include transfers between individuals who are not married or in a civil partnership. Sorry, I'm just waiting for the slide to come across. So you're probably wondering what is meant by living together. Now, Section 1011, the Income Tax Act 2007, although income tax legislation does apply for capital gains purposes, And this states that those who are married or who are civil partners of each other are treated for the purposes of living together unless they are separated by an order of a court through a formal deed of separation, or in fact they are separated in circumstances in which the separation is likely to be permanent. Now, this is going to be particularly important when considering capital gains tax, especially during the year of separation. Now, after the year of separation is probably when you're more likely to see that a chargeable gain will arise. Now, the date of disposal and deemed considerations is very important for capital gains purposes. It will be HMRC's perspective, but also the individual. For example, they might have reporting requirements when the gain needs to be reported, when the tax needs to be paid. So this needs to be considered very closely. There are several dates of disposal, and it will ultimately depend on the factual background. I'm going to talk today about HMRC's practice. Now, the court will normally divide the assets and make an order when an agreement has been made. I'm not going to talk about measure orders today, but feel free to contact me afterwards if anyone wants to have a chat regarding that. Now, HMRC's view is where a transfer is made in pursuant of court orders, probably three main ones really. So where there's a transfer under a court order before a decree absolute or final dissolution, the disposals can be treated as a contract, and that date of disposal will be the date of the order and not the date of the decree absolute or the final dissolution order. If the asset is transferred after the date of decree absolution or following the date of the dissolution is final, but on an order made before this date, the date of disposal is going to be the date of decree absolute or the date of dissolution is final. And finally, where a court order is made after decree absolute or after the date that dissolution is made final and the assets transferred in pursuant of that order, it's going to be the date of that order. Position is different if it's transferred underneath the contract rather than the court order. So for example, if the contract is unconditional, the date disposed will be the date of the contract. But for example, if the contract is conditional on a number of requirements, the date disposal will be when all the conditions have been satisfied. There have been issues in the past when it comes to matrimonial home, but case law has kind of said that where there's a case or where there's a consent order, it requires a transfer asset. In divorce, the disposal kind of takes place on the date of the order rather than the date of the early agreement between the parties. And now it's just one to talk about the sale consideration. So until the divorce or dissolution actually takes place, the couple are still going to be married or in a civil partnership, and therefore they're going to be connected persons. So as previously stated, the disposal in the year of separation is going to take place on a no gain, no loss basis. But you'll see in the slide here, after separation, so after that year of separation, the party is going to be treated as connected persons by virtue of their marriage or civil partnership. And therefore, disposals that take place before the decree absolute final dissolution order are deemed to take place at market value. Now, once the decree absolute or final dissolution happens, they're no longer going to be connected by their marriage or civil partnership, although you have to be careful because they could still be connected for other purposes. And generally here, you use the actual consideration rather than market value, but just be careful because if it's not arm's length, then the actual consideration won't be used. And as you can see at the bottom here, if the asset is transferred under a court order, it's not going to be at arm's length, so you need to consider the market value. So, it's always important just to be aware of that market value. Now, we don't have enough time today to talk about what's known as clogged losses, and that's why I'm including them on the side. But essentially, these are losses between connected parties, such as a husband and wife. Now, special rules dictate that these can only be offset against chargeable gains arising from transfers to the recipient spouse when they're connected. So that's, for example, from the year of separation up until the decree absolute. So specialist tax advice should be sought to ensure no loss are wasted. So, for example, after the decree absolute, when they're no longer connected and they have these clog losses, it could be wasted. So, it's always worth getting tax advice to, make sure your client's position, they lose all losses available. The next thing I want to talk about is private residence relief. Now, it's probably one of the most known capital gains reliefs. And the main rule behind it is that any chargeable gain made on the disposed by an individual in a dwelling property, which is their only or main residence. In these circumstances, private residence relief could be available, and it can reduce a chargeable gain potentially to nil. And generally, a chargeable gain will only arise when the individual has been absent from the property during a period of ownership. So this could be, for example, where they've let out the property during a certain period, or they've been absent from the period some time and there's no deemed occupation. Now, as you can see from the slides, couples who are not married or in a civil partnership will be entitled to one property each for private resident relief purposes. Now, they lose this entitlement on marriage or civil partnership if they are living together. Now, if at the date of the marriage, they each own a residence and they continue to use both as residences, they can jointly nominate which of these to be treated as their main residence for private resident relief. And they have 2 years from the date of marriage to make this election, and effectively one property will cease to qualify for private resident relief for this period and will be subject to capital gains tax. So you're probably wondering as well, oh, sorry, at the bottom there. So from the 6th of April 2020, if any property or share of any property is transferred between spouses who are living together for any part of the tax year, the period of ownership of the transferee is treated at the beginning of the start of the period of the transferor's ownership. So this is, this could be a useful tool for capital gains purposes. So you're probably wondering what's happened on divorce or dissolution. Well, generally, it will mean that someone will leave the marital home. So from the 6th of April 2020, in the year of separation, certain conditions are met at the date of transfer. The transferee may be able to acquire the private resident relief history of the transferor, in which it's a very useful tool. Another point to note, if the partner who's leaving the property leaves the property, and within those 9 months, they manage to sell the property, private resident relief will be available for these 9 months. And this is because the last 9 months of ownership used to be 18 months. It's always treated as deemed occupation as long as they've lived in that property at some stage. Now, this can be extended for a long period of time if one of the parties is disabled, but I won't go into too much detail about that today. Now, one of the main issues is that sometimes it can take longer than 9 months to sell a property, especially with current market conditions. So a chargeable gain could arise after this 9-month position. However, and this is important, so the private resident relief can still be available where there's a transfer made under agreement between the spouse and civil partners or pursuant to a court order, such for example in divorce or a dissolution of partnership. In the period between the individual moving out of the property and disposal to the spouse or civil partner continues to be the only or main residence of the other spouse civil partner, and that the individual that's leaving the property is not elected for another property to be their main residence for any part of that period. So this could be, for example, where the spouse leaving the property still owns a part of it, and private resident relief will be available on the subsequent transfer to another spouse from the date of their occupation ceases until the date of the transfer. So it'll be really important for the departing spouse to take tax advice before making the main resident election when leaving the marital home, just to protect their private resident relief position. The next thing that I want to talk about is where parties are seeking to exchange interest in land which is jointly owned. And I think this is a topic that not many people are aware of. So in this first relief, where there's an exchange of interests which are jointly owned by 2 or more persons, and essentially one of them they will each become the sole owner of a piece of land. So without this relief, this sort of transfer could give rise to a charge for disposal, and capital gains tax may be payable even if there is no cash consideration. Let's say, for example, there's a husband and wife who don't live together and they own a commercial rental portfolio, so it's like rental properties, for example, and private resident relief isn't relevant in these circumstances. This kind of relief is kind of like rollover, and it ensures the gain doesn't crystallize at this point when it's transferred, and the base cost of the replacement land is reduced accordingly, and it kind of defers the chargeable gain until the asset is sold at a later time. It is important to note here that spouses and civil partners who are living together, as per the definition earlier, are treated as a single landowner or a single co-owner for the purposes of the relief. And as you can see on the slide here, the amount of the relief will depend on whether the exchange of interests are of equal value. Now, if there are different values, it's likely that chargeable gain will arise. So it's best to get tax advice on this position. It's also important to note that specific relief does not apply with respect to excluded land. And this is generally a dwelling house, which would attract private resident relief on its subsequent disposal within 6 years of acquisition, or becomes excluded land within 6 years. In these circumstances, as detailed in the slides, there could be a clawback of the tax available, the relief available. Now, there is a time limit at the bottom here, and that's generally 4 years from the end of the year of assessment to which the exchange takes place. So I thought we'd take you through just sort of a quick diagram here. So as you can see, we've gone all out with the graphics, and I'm going to use an example here of Mr. and Mrs. Claus. So Mr. and Mrs. Claus, they both own 2 rental properties, but they don't live together, and they're going through a divorce, and as I said, going through a divorce, and they're not living together. What would happen here is that Mrs. Claus would transfer 50% of property A to Mr. Claus. Mr. Claus would transfer 50% to Mrs. Claus. And effectively what would happen is that Mrs. Claus would own 100% of property A, of property B, and vice versa. So they each own 100%, and their base cost of it would be reduced accordingly. And this is on the expectation that we're of equal values. As I said earlier, if there are different values, then you've got to be careful because the chargeable gain may, it will arise. And there is another additional relief. Now, I know that private resident relief for the last one kind of excluded it, but there is this additional relief where there are 2 properties in joint names, and on separation, each spouse will want to live in the other property. So this relief would apply where there's more than one house and husband and wife live in different properties, they own the properties jointly, and they're not living together within the definition, and they're separated. They exchange interest, so each party will become the sole owner of the house, which they will then use as their principal private residence. So that's important about it being their principal private residence. I won't go through all the conditions for the relief, but where the conditions are satisfied and a joint claim is made by the landowner and the co-owners, the consideration for the disposal of the relinquished interest will be on a no gain, no loss basis, and the acquired interest is treated as being acquired at time of its joint acquisition by the landowner and the co-owners, and for consideration equal to the cost of acquisition and the co-owners. So where an individual disposes of an interest in the dwelling house, which is the only or main residence, in exchange for interest in another asset, private resident relief is due in the usual way on the dwelling house sold. And this and the value of, as said previously, the value of the asset received is the measure of consideration received for the disposal of the property. So this could be useful to make sure no chargeable gain arise. Again, you need to be careful of the different values because the chargeable gain might arise. And as per the previous slides as well, spouses and civil partners who live together will be treated as single landowner or single co-owner for this relief. So for both reliefs, if they are living together, they'll be treated as single landowner or co-owner for this relief. And it's a similar time limit to making the claim as well for the previous claim. So that's all I have today. So what I'm going to do is I'm going to start the poll. And essentially this states that in your experience, when are the tax implications of a divorce, dissolution, financial settlement really considered? Is it A, before the decree absolute or final dissolution order, after the decree absolute or final dissolution order, or they're just always considered too late? Smiley face. So what I'm going to do is I'm going to launch the poll now, and I look forward to receiving your answers. I'll keep it going for a while. I can still see that some people are trying to make their minds up. I think I just noticed as well, I've not had my video on, so I must apologize for that. I'll give it another 30 seconds to see if anyone shows up. We've got a tiebreaker, so I'd love someone else to put one in. Let's see. Okay, I'll end the poll here. So as you can see, we've got a dead neck between before the decree absolute and final dissolution order, which is obviously it's very reassuring, but it's also considered too late. So from everything that I've said in my slide, the different considerations about need to be considered. You know, I think the no gain, no loss is a very useful tool for a lot of individuals. So, you know, if there's anything that you go away from today is being aware of the no gain, no loss principle, you know, it's very, very useful for capital gains purposes. So yeah, I'll pass you back over to Paul.
Thanks, Ben. Right, Ben's done all the hard work there. I've just got a couple of easy subjects just to finish off with today. Swapping assets. I think Ben alluded to this, but it's all pretty important stuff. If you're swapping an asset, you've got to bear in mind it's not a gift. It's a CGT disposal, and that's even a problem if you're outside of the year of separation. So if you can't claim rationalisation on the swap, you've got to try and find other ways of relieving it. I had a case just this year actually whereby an accountant told a couple divorcing that they could claim gift relief on swapping shares in a trading company. So they didn't factor in the tax on that capital gain into the divorce. It turned out that wasn't the case, and tax was payable, and that caused a problem within the divorce. So bear in mind, swapping an asset is not a gift. Very important. Stamp taxes, obviously, stamp duty on shares. The bottom point there, only 0.5%, so not that significant, but it should be. Divorce should be free from stamp duty if, in the same way as SDLT there, if the transfer is made in relation to a court order or an agreement in terms of a divorce. So if we're getting an official divorce, we know we can avoid stamp taxes, so that's good. It's not as complicated as CGT. Demerger. I'm sure some of the solicitors and people attending this webinar today have been involved in a demerger in terms of a divorce. And what we've got, generally speaking, is where we've got a company, maybe one company or a group of companies that's owned 50-50 or whatever by the spouses, and they want to split some of the assets within that company to one person and some of them to another person. We can do a demerger. So that could be where we've got investment properties within one company, which we want to sort of half. So we've got 10 investment properties within one company. We want 5 to go to one spouse, 5 to the other. The demerger is a classic tactic because what it does is it gets 100% of their allocated assets into their own company. And if it's done properly, it can be tax neutral. Sometimes there could be some stamp duty here and there knocking about, but if we do it properly and we get the right structure to the demerger, we can avoid tax. Another important thing is actually we can avoid loans between the companies as well. We can avoid any loans between the two companies, which will cause problems for a divorce. And we can also arrange it such that if one party is getting a bit more in terms of the asset value, we can sort of arrange it so that the other party gets either additional cash or does get a loan from the other company to sort of balance that up. So we can be quite creative with the demerger, and it is a good tool for divorce, most definitely. And there's a bonus, if we do it properly as well, we can get some uplift on the properties that move through the demerger. We can get a tax-free uplift in the base cost of those properties, which means if those properties are sold in the future out of the company, there'll be a lot less tax to pay by the company. So demerger is a really good tool for divorce if you've got that type of situation with companies. Valuations, obviously valuations are important for divorce, we know this. Trading companies, looking at here, sort of minority interests in companies, goodwill on some sort of partnership or sole trader type of arrangement, and investment companies. So they're often required for divorce. And just bear in mind that a valuation for divorce is not necessarily one that's the same for tax, although it will be significantly influential. There could be some adjustments to be made for tax purposes for the one that's agreed for a marriage. So we're running out of a bit of time, so we're just going to move on. Don't forget, every situation is different, so we're always here to help. Please call Ben or I on that landline number to discuss any issues. The next webinar is on the 14th of January 2022. And we're talking about SDLT overview, multiple dwellings. Quite an interesting topic. Some surprises on that one. Sometimes you can pay a lot less tax than what you think you will be. So before we move on to any questions, we just want to wish you a Merry Christmas and a Happy New Year. And now we've got some questions. Laura, have you got any questions for us? We've only got 4 minutes.
Yeah, so we've just got a couple of questions. So the first one is, does it matter if they are joint tenants or tenants in common for rationalising property interests?
Yeah, so the legislation makes it quite clear when it means to hold the land jointly means for England and Wales, it's to hold it as joint tenants or tenants in common. It seems to say that position is quite clear that it just needs to be either joint tenants or tenants in common.
Great, thanks, Ben. And second question that we've got is, if a husband and wife transferred assets, including cars, furniture or paintings, for around £5,000 each after the year of separation, but before the decree absolute, what would the capital gains implications be?
Well, yeah, so for example, cars are exempt assets for capital gains purposes, and I think when it comes to a lot of the items potentially in the marital home, this could be quite important. It's all to do whether or not it's a chattel, and essentially, if this proceeds of sale are less than or equal to £6,000, any resulting capital gains will be exempt from capital gains tax. So this could apply to numerous items within the family home. Just be important to bear that in mind, I guess.
Great, thank you. Do we have time for one more?
Yeah, I think so. I've got 3 minutes.
Great. This one's regarding a marital home sold after 9 months. I'd like to know, what is the cost for CGT, original cost or MV at time of separation?
Sorry, Laura, can you repeat that again? Sorry.
Yeah, so it's regarding a marital home sold after 9 months. What is the cost for CGT, original cost or MV at time of separation?
Cost of the property. It's ultimately going to depend. So it might be worth me. Is it Ian that asked this question?
Yeah, that's right.
Ian. What I'll do is after this, I'll give you a call and see if we can have a chat through it all. It does depend on multiple factors. So I'll give you a call afterwards, if that's okay.
Great, thanks, Ben. There are a couple of questions that I've noticed in the chat box as well. So I'll make a note of those and we'll either drop you guys an email or give you a call to discuss those with you.
Okay, thank you very much, everybody. So now we've just got a breakout session for those people who want to stay on the line and chat through any items that they want to. So yeah, you can stay on the line and you label your mics for those people who stay on in a minute's time. Those people who want to leave, great, and have a great Christmas.
Yeah, Merry Christmas, everyone.
Hope you've found it of use. Thank you. Oh. Okay, we've got some people left on, so we'll just open up the mics. Allow to talk, allow to talk, allow to talk, allow to talk. Hi there, everybody. Who would like to ask a question in today's breakout session? You've all got your mics enabled now, so you can all talk, I think. Can you all talk?
Yeah, I think they might just need to, if anyone wants to unmute themselves, I think. Then they need to.
Good point, Ben. If anyone wants to unmute themselves to ask a question, that's fine. We've got 2 people left on. We've got Colin Hudson. Hi, Colin. We've got Ramsey. You 2 guys like to ask any questions in particular? I think the people have left. Ben.
Yes, yeah. Colin or Ramsey, if you want to, if you have any questions afterwards, feel free to get in contact with us, and we can have a chat.
Right, nice one, Ben. Yeah, I'll stop the webinar.
Yeah, brilliant.
Cheers. Bye.
Bye.